right, good afternoon, everyone, and thank you for joining us today for the Cornerstone Wealth Financial and Market Update. I am Jeff Carbone, Managing Partner at Cornerstone Wealth, joined today by our CIO, Chief Investment Officer, Cliff Hodge, calling in from our Columbia, South Carolina office. Thank you, Cliff, and welcome.
Yeah, thanks, Jeff, and thanks everyone for spending some time with us this afternoon.
Well, as we have been, we are recording the webinar today, and we'll send it out and we'll post it to our website for everyone to view if they do not get to complete or want to share it with friends, family, co-workers, or anyone interested in hearing more about our market updates and financial updates. So pass it along. Also, if you do need to go to our website is www.cwgadvisors.com. If you have any questions or need to get in touch with us, you could also reach us 800-738-6734. So, well, and I guess lastly, if there's any questions, you'll see the question box. Just submit a question. We'll try and get to it at the end of the presentation. So Cliff, a few days early before the end of, or halfway through, we get through the midway point of 2021. We're also a little early to maybe the start of the dog days of summer, which do begin on July 3rd and typically go through August 11th. And just like those hot, humid days of weather we get, the markets get typically the dog days of summer as well. Typically see vacation times pick up. Trading volumes may come down, and we see a little bit more, just a slowing in the volume of the trading, etc. So a little quieter time on Wall Street. But Cliff, before I ask you to share your market update today, just a quick brief update on some of the planning updates. Again, as of today, the 29th of June, not a whole lot of changes. Again, the big ones we were waiting in anticipation of from President Biden was on the tax and the estate tax front. At this time, really nothing has come through. Only proposals that, again, President Biden has run under. We've seen a few thoughts come out, but brief, just to remind everyone, things that we're anticipating, some changes in a tax bracket. We could see a new tax bracket, or the bracket go back to 39.6% being the highest tax bracket. We're also continuing here increase in capital gains rates, which could go to as high as as ordinary income tax rates. There can continued discussions on the lowering of the estate tax deduction, which today stands at 11.7 million per person, going down as low as 3.5, maybe to 5 million, somewhere in that range. And another big one is the step up in basis that could go away, where upon one's death, the step up would go or would carry, or the basis would carry over and that step up at death would go away. So continuing to listen here, keeping our eyes and ears open to see what kind of changes are coming. One item that did come up that we've already heard is then on capital gains front that could possibly go back to, if anything, after April 30th, would possibly go to the new capital gains rate should it pass and go through Congress. Anything prior would be on the older rates. So still waiting to hear on any of that. So as we kind of talk and move towards the market discussion, stocks continue to hit record highs this week. We saw a brief pause maybe a week and a half ago after we had the Fed meetings. Kind of a little bit of I'm going to steal Cliff what I think when we were talking the other day, you kind of called it a Dr. Jekyll, Mr. Hyde type of market. We just didn't know who we were going to get what day. But now we're switching to inflation valuations. Infrastructure hopes have been really dominating the headlines this week and the past few weeks. And really, probably in the next 2 weeks, we'll switch those headlines to earnings and Q2 data that will start coming in. So Cliff, let me turn it over to you and let's discuss what's transpired over the last quarter from our last call, what we're watching and how we're positioning the portfolios at this time. So
Thanks,
Cliff,
Jeff. Yeah, and just want to check you can see my presentation there, correct?
we're good. Thanks,
All
Cliff.
right. Yeah, I actually forgot about the Dr. Jekyll and Mr. Hyde. That's sometimes you get a good one every now and then, right?
You had a good one.
Great. So yeah, what I thought we'd do today, and again, thank you everyone for joining us today. I really enjoyed putting these together. It's a bit of a labor of love. A lot of graphs and charts go into it, a lot of practice. So thank you to Jeff as well and Ashley for getting these on and organized. What we'll do today is do a quick review of where we've been. We'll look at what's happened, some of the things we said on the 2Q call, what's transpired. Then we'll shift gears to what's happening today, more importantly, where we think we're likely to head next. And then lastly, how we're executing on that from a positioning standpoint. So with that, we'll get started. And really the story for the first half of this year has been how nearly $10 trillion in combined fiscal and monetary stimulus, which is almost 50% of annual GDP, how that has driven the fastest economic recovery in history from the fastest trough and breakdown in history. So things are moving very quickly out there. As you can see, on the slide on the right, the GDP chart, that breakdown in 2Q of 20 was the worst quarter going back to the Great Financial Crisis, even worse than that. We've actually had a quarter of year-over-year growth, slight beat this quarter, but then right on the heels of that, second quarter 21 GDP growth is expected to be the best number since the early 1940s. A couple of other interesting stats on the labor market. During the pandemic, we lost over 22 million jobs, which was over a decade's worth of gains in just a few short weeks. But the good news is that as of last month, we've gained back nearly 14 million, which is about 60% of what was lost, and effectively has compressed 7 years worth of normalized hiring in 1 year. So the pace of the markets and the economy is really unprecedented. So the following chart shows an update of the nowcast model. So these are the 30 monthly data points that go into our quad forecast. A lot of information, a lot of noise here. The key takeaway I want you to look at is the color coding. So you look back at March, April, May of 20, that deep dark red indicates how horrible things were from an economic perspective. Now to the right-hand side of that chart, you've got bright green, really, really across the board. And no surprise, if you look at the S&P on the right-hand side, the market, which is a discounting mechanism for the future, has done a fantastic job in pricing in the recovery, being up 88% from the trough, now trading at about 21.5 times forward earnings, which is higher than every other number on this chart other than .com. But if you look at it from the market cap to GDP perspective, which is another metric that we've referenced in the past, now trading at 205% of GDP, which is the highest level in history. So certainly a lot of exuberance out in the market. And before we shift gears and talk about what we're seeing today, where we're likely ahead, I thought it would be fun to go back and review what we said in April and give ourselves a bit of a report card to see how we did. And so these bullet points were taken from that presentation. But what we said was that at the time, we thought most of the good news had been priced in at the index levels. The S&P was up 10. Valuations were stretched as they remain today. We've had flows coming in, buying stocks, but that opportunities did exist for active managers. And on this one, we get an A+, we get a check mark. Since April 15th, which was the webinar, the S&P is only up 3% since then. Values up 2, growth is up 4. So that's the breakdown. But on the active management piece, we're also going to give ourselves a check mark there as well, related to that second bullet point for commodities, right? So commodities are something that are not in the benchmarks, but if you're active perhaps something that you could take advantage of, which we did so in really any of our equity strategies. Commodities are up 9% since then, so almost 3x what the S&P 500 has done. That second bullet point, we mentioned inflation. We thought inflation was going higher. That was a high conviction call back then. Coming off of a 2.6% CPI reading in March, we got 4.2 in April, and then 5 in May. That call has come in quite nicely as well. So we're going to give ourselves a check on that one also. But not all sunshine and roses, so to say. The last bullet point, we did call out a breakdown in small caps, cyclicals, some action in the yield curve as well. So that those signals, along with a few others, caused us to want to raise some cash in our portfolios, increase the quality. We've gone on to make all-time highs, 3%. We feel okay about this call. We haven't really left that much on the table. And we're going to talk a little bit more here momentarily about why we still have conviction in that call. So Jeff, given that we did a pretty decent job in the last quarter, does that mean I get to keep my job for another quarter?
We'll keep you around for another quarter, Cliff. When you have the three things, it reminds me, if anybody remembers Meatloaf, the singer, 2 out of 3 ain't bad. So I would say I'm going to give you a good solid A, Cliff, no matter what. But
thanks.
But I still go back to your first slide when you're looking back at the amount of stimulus that we've pumped into the economy. Again, that $10 trillion. It's just and I think you and I have talked before. We don't talk billions, we talk trillions. So it's going to be a lot to kind of unwind, right, and get back in. So maybe that leads into the outlook and where we think we're going at this point.
Yeah, Jeff, as we said, markets discount the future. It's what have you done for me lately, right? And then to steal a comment from the great one, Wayne Gretzky, probably the most overused sports quote in investing in finance. But the idea that we want to skate to where the puck is going, right? Not where it is or where it's been. So we're always trying to look around the corner at what's next. And for us, for the third quarter, these are really our three key themes. So preparing for the pivot, stuck in the middle from a cycle perspective, and then lastly, a successful handoff or a fumble on the 1 yard line, which we'll kind of talk about each one of these. But in preparing for the pivot, right, we've come through really the easiest year-over-year comparisons that we've ever seen, likely will ever see again for the duration of our careers, barring another global pandemic, global shutdown. So the path forward is going to be more difficult from here, right? Our models are indicating that growth deceleration is almost a mathematical certainty at this point. So in quad parlance, which we'll look at here in a moment, that's going to be 3s and 4s, with quad 4 being the highest probability outcome for the third quarter. But that importantly, growth is going to continue to decelerate really over the next year. So that's point number 1. Point number 2, cycle time, stuck in the middle with you. We talk a lot about the quads, but I also don't want clients to lose sight of the business cycle. Which is really the more structural and persistent part of our process that really goes hand in hand with the quads. I like to think of the business cycle as the map. It gives you the lay of the land. You kind of have an understanding of your destination. But the quads are really the GPS, right, which we use to navigate real time and day to day. And so our analysis indicates that on the business cycle side, we think we're in for a shift from the early cycle expansionary phase into mid-cycle, which is going to have some pretty significant ramifications on asset markets and risk, which we'll look at here momentarily. And then last but not least, what we're calling the handoff, right, which is just the trends, how the economy and the markets transition from that $10 trillion in stimulus to now having to stand on its own 2 feet. as we navigate toward the future. Key takeaway there is that there's likely going to be a bit of volatility ahead as these crosswinds all begin to come to fruition. So quickly, we'll just review the quads. This graphic is a very much an oversimplification of what we do from the quad process. It's a framework for rates of change in growth and inflation. That's important because, as you can see on the right, they drive returns, across the market, asset classes, sectors, style factors, so on and so forth. It's not about good or bad. It's always about better or worse. It's important. I'll call out. I mentioned periods of quad 3s and 4s over the next year. Lower expected returns is one of the key takeaways. Last time we all got together, the forecast was for 2 quarters of quad 2, which we did get, and second quarter 21 was actually the steepest quad 2 in the history of our back test. So we go from that, where you want exposure to cyclicals and reflation, to quad 4, which is we call that in the playbook the danger zone. So that's the highest probability of negative returns or pullback, and a lower hit rate on being positive versus being negative. Want to call out here, which I've circled in red, even though GDP growth is likely going to be elevated for the next 4 quarters, again, it's that rate of change, it's that trend. Slowing is what is certainly important for us. So that's the view for the quads. That again is the GPS, the real-time navigation in our process, all based on data, as we saw in the nowcast. But we do track a lot of data, Jeff. And one of the things I get asked by clients and advisors alike is, of all the data points we track, are there any favorites or any that we like to go back to the well so to say? And one that I keep coming back to, that I've written and talked a lot about, is the PMI, so the Purchasing Managers Index. We track the ISM Manufacturing. So it's a survey or a diffusion index. Anything north of 50 means the economy is expanding. Anything below 50 means it's contracting. It's really important because it helps us to navigate the business cycle, which again is the longer term view of the economy and the markets. And what we're seeing on the most recent readings is that we are now peaking and perhaps rolling over, which is very similar to what we saw on the call outs here, 94, 2004, 2011, post the initial burst from the global financial crisis. And now today, right? So this indicates to us that the economy is moving out of this early cycle expansionary exuberant phase to the mid cycle where the economy and markets tend to peak, right? And that's important because one of the major themes of this pattern is valuation contraction. So the PE ratios, which are extremely elevated, as we've talked about, begin to compress a bit, right? On average, 20%. Doesn't mean that it's all going to come for prices. So the PE ratio is price divided by earnings. Could be a combination of prices coming down, earnings going up. But we are expecting multiples to contract. This is important given that we are at pretty lofty valuation levels. So if we think about these 2 topics that we have just discussed, you've got an upcoming quad 4, and you've got now mid-cycle transition, are both a bit bearish for us at the margins here. So these are a couple of reasons, along with a few others, why we have been a bit more cautious and have held some cash. So then, Jeff, we understand what's happening in the macro. We also want to look at what's happening at the market, the company level, from an expectations perspective. These are our consensus investment bank and economists earnings per share growth estimates for the S&P 500. Exuberant, is probably the word I would use to describe it. Over 50% in 1Q, which we met, was fantastic, business results. Then over 60% for 2Q, settling out at roughly 20% growth year over year, each quarter other than 1Q 2022, really for the next year and a half. So expectations along with valuations are all very high, and there's a lot of exuberance in the market. Meanwhile, we have this catalyst, which is the Federal Reserve. As clients may or may not be aware, at the last meeting, the Fed began to pull forward tightening expectations vis-a-vis their dot plot, which are the projections of the committee members who vote where interest rates are going to be for 2023. And you can see that over time, each of these lines here is their last 4 meetings, they've become more bearish or more supportive of higher interest rates, which means tightening financial conditions. And they're also talking about tapering, right? So monetary tightening. This matters. Well, before we say why this matters, want to let everyone know up front, we're not calling for a crash by any means. See crash and people may get a little bit uptight about it. We're not calling for a crash, but every crash in modern history has been preceded by a tightening Fed. So when they start talking about tapering and raising rates, our ears perk up for this reason. We think if anything, we connect the dots. So you've got quad 4, you've got mid-cycle transition, pie in the sky earning expectations, historic equity valuations, and a tightening Fed. We feel that it, given all those data points and connecting the dots, that it is certainly prudent to have a bit of cash on the table. But when and if we do get a correction, we think it'll be certainly more of a run-of-the-mill 10-15% is what we're thinking. Anytime between now and perhaps September. So the last theme that we wanted to hit on is the handoff. So again, nearly $10 trillion in the U.S. in central bank and government stimulus, good for almost 50% of annual GDP in the U.S., almost 30% of annual GDP globally. So as these benefits begin to expire, which are happening now, if you look at the number of states highlighted in red, these states have all ended the additional PUA, pandemic unemployment assistance benefits, before they expired at the federal level. Nearly 4 million recipients, or about a quarter of those folks that are getting some sort of extra benefits, are going to be rolling off over the next 6 weeks. So that is a pretty significant fiscal cliff, so to say, of transfer payments that will no longer be coming in. So how does the economy handle that transition to the idea being that if the government starts paying people less, it will incentivize them to get back to work? We're seeing that in the labor markets, right? So the NFIB small business survey, when you look at how hard is it to fill your open jobs, highest level in history. This chart goes back to 86. So there's extreme tightness in the labor market. So hopefully, as the benefits roll off, people will begin to go back to work, and we don't miss a beat. That's the optimistic view. But however, this is also important because there is a very high correlation between this data point, which is a measurement of tightness in the labor market, and wage growth. So as the jobs hard to fill index is high, when labor markets are tight, it does typically lead to higher wage growth as businesses have to pay up more to compete for employment. This matters to the economy and to our process because higher wages are a leading indicator of, drum roll please, inflation. which is the topic du jour today. I'm getting more questions about inflation, really versus anything else. Whether it's transitory, whether we're gonna see a 1970s style hyperinflation. We certainly don't think we're in for anything like that. I'd say that there's no doubt that a chunk of what we're seeing today is transitory. Things like lumber prices, used car prices, copper, right? For example, that will likely burn off and be a bit transitory. But there are other components that are more structural, like rent, for example, is a big one. It's about a third of CPI. Has not made a big move higher yet, but likely will. So the key takeaway on the inflation front, what we're seeing is that these extremely high levels of inflation, 5% CPI, we think that's transitory, but it is likely that inflation may settle out at a bit higher levels than what we've been accustomed to for the last decade. So think 2.5, maybe 3 instead of 1.5 versus 2. So Jeff, I'm sure you've had clients ask questions about inflation. What are your thoughts?
Yeah, no, well, certainly like topic of discussion, right? Inflation and what, certainly the difference between the Fed's thoughts on transitory and I guess our more on this is not a transitory inflationary issue. Inflation is real. So, Cliff, you went over a lot of information there. So I just want to do a quick recap on some of the key themes that you just went over, and you had it in your slide. But again, part of the key themes that we're preparing at Cornerstone is, again, the pivot, right? That we're preparing for the pivot and the path forward from this quad 2 that really began back in our view, in our investment process around October, November, and that transition to a quad 4, quad 3 with slower growth and watching the inflationary pressure. It's also that movement from a early business cycle to a mid business cycle where we increase more to a higher quality positioning, higher quality, bigger names, both on the equity side as well as the fixed income side. And as you went through and with all the stimulus and talking through the employment data, will that be enough to offset all that stimulus and keep us going? But we anticipate, again, a little bit more volatility increasing, but also the inflationary pressure coming along. So again, just a quick recap on those themes, because that leads now, Cliff, into with those themes and what we're seeing, where do we start going and where are we positioning the portfolios for our clients today?
Yes, thanks, Jeff. You teed me up nicely for that one. So this slide, number 20, is really the takeaways from a portfolio positioning perspective. So we have been preparing for multiple quarters of quad 3s and quad 4s, right? The thing that we're confident in is that we know growth is going to be slowing. Inflation is likely going to be volatile from quarter to quarter. So it's all about the rate of change year over year. So we're coming off of a high level in 2Q where we've got 5% CPI. We may get another month or two of pretty extreme readings, but then as those base effects roll off compared to the trough of COVID, it's likely that it'll trend down and then kind of settle out, right? So we may see, we're going to see a combination of 3s and 4s. So really what we're focused on and what we want to be doing is adding things that work in both, right? Which is the barbell. We talked a lot about that in 2019, which is a combination of growth and defensive exposures. And we'll look at the playbook here momentarily to dive into some details. Just because we're overvalued and we're seeing these data points doesn't mean that the correction is going to start tomorrow. Doesn't mean that we can't grind a little bit higher from here, but we do always think about the portfolios and investing through a risk and reward perspective. And so we think that at least for the next few weeks that is perhaps skewed a bit toward the downside. I should also mention quality. I didn't write that on here. but we said it earlier in the presentation, the number one pivot across the board, whether it's equities, fixed income, commodities, alts, whatever it is, you want higher quality going to this part of the cycle. So think about things that, from a stock perspective that have strong earnings, they're compounders, right? High returns on cash, high returns on equity, returns on capital, so on and so forth. Fixed income, we have begun to shift our duration back a little bit higher. We're still underweight relative to the benchmark. Again, duration is sensitivity to interest rates. We've kept that very low. We're going to move that back up here a little bit. Again, quality tilt on the bond side as well. And then last but not least, given the environment, alts or alternative investments continue to be our highest conviction allocation recommendation. So, I would encourage folks, if you have not spoken with your advisor about alts yet, please do so. We've got, various options, whether that's on the liquid side where you can access all and most of your capital immediately, or on the private side where you're getting that illiquidity premium, where you can get pretty nice returns if you're okay with some various lockups. So then we look at the playbook, right? So we've been in quad 2. I'm gonna steal my analyst Sean Bandazian. He's most likely on the call. He talks about the 4 horsemen. So things like industrials, financials, materials. There's one more, discretionary, I believe, that are very cyclical, tied to the economy. Those are the areas that you have wanted to be in, that we have been in really since October, November. Now we want to shift toward the barbell. So things like growth from a style factor perspective, quality, as I mentioned, things like technology that work well in a growthy environment, but also things like utilities, REITs, healthcare, things that can be a little bit more of a ballast in those slowing growth environments. From a fixed income perspective, again, quality is the key takeaway. So treasuries, investment grade credit, things like that work in both quad 3 and quad 4, and we'll begin to move out of some things like BDCs, preferreds, converts, so on and so forth, that may not work quite as well. Now we do like the yield component that some of those areas offer. So it doesn't mean we're going to make a wholesale shift and sell everything, but we are selectively going to move out of, again, those cyclicals toward the higher quality ends of the markets. Yeah, and then alts we've already talked about. So with that, Jeff, I will send it back to you to take us home. It does look like we have a couple of questions here. Oh no, it looks like we answered it. So thank you.
Well, I think that maybe Cliff, we had one question. I'm not sure if we got it fully, but from Will, just I think it's more about the grid and the quad process, that kind of his thoughts on the quad 4 is defined. If we're looking at quad 4 with slowing growth but decelerating inflation, that was closest that we could remember. That was during the midst of COVID. Great, just a reminder, that's when everything fell off the table. But quad 3 defined more as decelerating growth but rising inflation. I guess his questions were, if we're expecting inflation for the second half, wouldn't we see more of a quad 3 versus a quad 4 scenario in that case?
Yeah. So it's really all about rate of change, right? So we think we're going to peak and then come down and then settle out, right? So it's going to be a combination of both. Now, immediately for the third quarter, we think that's where you're going to hit that peak and then perhaps roll over a bit. But longer term, combination of 3s and 4s. So we really want to have exposures that work well in both environments.
Yeah. Well, and I think, Cliff, again, it goes back to that barbell approach that we're taking right now. A little bit of, we got the growth continuing, but starting to add a little bit more defense, a little bit more value. a little bit, again, higher quality, et cetera. So Cliff, thanks for sharing all the information. Again, always come away with some with additional knowledge points or some new points that when we do this together. So I appreciate your time today. Just reminding everybody, again, want to visit our website at, again, www.cwgadvisors.com. If you have any questions or we have any additional comments, anything we can do, want to follow up on any thoughts on the markets or anything that Cliff discussed today, again, just give us a call, reach out to your advisor. We'd be happy to kind of discuss further with you. Again, when you will send out, Ashley will be working on getting this through compliance, and we'll get this sent out. So share it with those that you may think are interested. So on behalf of Cliff, myself, the whole Cornerstone team, we want to thank you for joining us today. Want to wish you and your families a safe and happy 4th of July. Enjoy your summer. Be safe, be healthy. We look forward to seeing and talking with you real soon. Thanks everybody for joining us today.